Welcome to your virtual CFO coach. I'm your host, Leah Torbert, founder and CEO of Harrington Strategic Partners. I've spent my entire career working in the startup world, scaling businesses to multi-7 and 8 figures. I built this podcast to share all of that knowledge with you and make your path to success shorter and easier. Tune in each week as I cover topics including financial analysis, cash flow management, holistic strategy, mindset, and more. Now for today's episode. If you're wondering what you can do to pay less taxes this year, even though it's already November, you're in the right place. Many tax strategies are industry specific or need time to implement, but there are some that most small business owners can use regardless of the type of business they own. So let's jump right in. Number one, the first thing you have to do is to make sure that your books are up to date so that you can estimate how much tax you will actually owe. It's hard to figure out which strategies to lower your tax liability would have the biggest impact for you if you don't have any idea how much you owe in the first place. So the first step is to make sure that all of your income and all of your expenses are recorded in your financial system. If you're using a program like QuickBooks, this is pretty easy to do. You make sure all of your business accounts are connected, sync your data, and review your financials to make sure income and expenses are recorded in the right place. So number two, did you make any large purchases this year? If you carry inventory, is your valuation accurate? If you purchased things like property, vehicles, and equipment, or made improvements to assets you already owned or leased, these are treated differently for taxes than regular operating expenses. So talk to your CPA about what your depreciation and amortization expenses would be for these purchases so that you get the correct tax deductions. If you carry inventory, make sure you do a physical count at the end of the year. Use this physical count to reconcile your inventory value in your books to capture all of your cost of goods sold. I've worked with several companies in my career where managing inventory was one of the biggest challenges that we had. A big contributing reason to that was the systems that were in place to accurately track what was coming in and what was going out. And a lot of times there would be errors made when adding inventory to the system or relieving inventory from the system when orders were going out. And so the physical count at the end of the year made a huge difference in making sure that we were capturing all of our cost of goods sold for the year. So this is definitely a step that you don't want to skip if you have inventory, because I have seen tens of thousands of dollars found in cost of goods sold for the year by doing a physical count and updating the system records. Number three, did you pay for any business expenses with your personal money that aren't recorded in your financials? While business and personal funds should definitely be kept separate, it's a fact of life that sometimes you grab the wrong credit card or you're just not thinking about what account to use. Review your bank and credit card statements to make sure that you don't have any missing expenses. If you made any large purchases for the business under your personal name and paid for them from your personal accounts, like a vehicle, for instance, then this is something that you would also capture here if you hadn't already captured it under strategy number 2. A lot of times you may not have the business credit that you need to purchase the vehicle or the piece of equipment, and so you have to contribute it personally from yourself to the business. If this is the case, just make sure that you keep all of the paperwork in a handy spot so that you know where it is in case there's any questions about it down the road. So number 4, do you have a record of your business mileage? If you travel for your business, you can deduct this as a business expense on your tax return. Mileage expense is not recorded in your financials. It is a separate deduction on your return. The mileage rate for 2023 is 0.655 cents per mile. So you should have a log tracking your mileage, including the date, the purpose of the trip, and your beginning and ending mileage as backup in case the IRS ever comes back and asks questions about your return. If you have toll charges related to your business travel, these are deductible as well, but you would record those toll expenses in your financials. And then number 5, make your final estimated tax payment by January 15th to avoid penalties. Regardless of how much tax you owe, it's pointless to pay your taxes late. Talk to your CPA about the IRS safe harbor rule. This rule has several calculations depending on your tax situation to determine how much you need to pay in for your taxes by January 15th to avoid underpayment penalties, even if you end up owing more tax after finalizing your return. It's very, very important that you make this final estimated payment. If you don't, you could be subject to thousands of dollars in underpayment penalties and interest fees, depending on how much money you end up owing for the year. So please reach out to your CPA about calculating what your estimated tax payment is for January 15th and make sure that you get that in to protect yourself from having to pay the government any more money than you absolutely need to. So the strategies that we've talked about so far are simple strategies that can be done without a lot of extra time and effort. Every business owner should go through this list every year to make sure that these basic expenses aren't missed. But now I want to dive into some more advanced tax strategies. You'll need to know whether you file your tax return on a cash or accrual basis before choosing from these advanced strategies. You can check your last tax return to confirm your accounting method, but if you're not sure, ask your CPA before you decide to implement any of the strategies that I'm going to talk about here in just a minute. The first group of advanced tax strategies that I want to talk about are related to the cash method. So if you file your tax return under the cash method, then this process will be very simple for you. Revenue is earned when you receive payment from your customers, and expenses are counted when you pay them, regardless of when the services are rendered. So what exactly does this mean? One way to pay less tax is to have less gross revenue. If a customer's invoice is due at the end of December and they send you a check for payment, don't deposit it until January. It will count as revenue for the next year. If you have expenses that you would normally pay in January, like subscription renewals or insurance, you could pay them in December to reduce net income, but only do this if you have the cash flow to cover it. Review your financials and see where you could make adjustments like these to reduce your tax liability. Under the accrual method, it doesn't matter when you get paid or when you paid for something. It's all about when the service was rendered. So what does this mean? Let's say you have some orders the last week of December that you need to fulfill. If it won't cause issues for your customers, you could ship them the first week of January instead, moving the revenue to the next tax year. On the expense side, think about expenses that you haven't received a bill for yet. Entering the bill is usually how you would capture the expense, but for accrual, even if the bill hasn't come in yet, you should be accruing the expense. A good example of this is freight bills. Freight companies are notorious for sending bills late, but the service was still rendered. It still happened. So make sure that you have recorded all of the expenses in December, even if the bills haven't come in yet, if you received the product or the service that you would be getting billed for. So now you have these 5 basic tax strategies and then some advanced tax strategies based on how you file your taxes. So what do you do next? Open up your calendar, schedule a time in the next week to start reviewing your options, and then you can decide what strategies will work best for you. Please consult your CPA for any specific tax questions that you have to make sure that you're recording everything correctly and capturing the best benefit that you can. Reducing your tax liability is a key strategy in managing your cash flow. As you're heading into the new year, I'm sure you're thinking about what else you can do to keep more money in your pocket and grow your business. While I strongly advocate for a long-term cash flow strategy, there are several things you can do to increase your cash flow in as little as 30 days. Today, I'm sharing my new 30-day Cash Flow Catalyst Group Intensive program. If you're ready to increase your profits, increase your cash flow, reduce the number of hours that you're working, or finally take that dream vacation you've been thinking of, then this is the program for you. Here's how it works. Over 30 days, we're going to analyze your cash flow and your strategy. You'll identify what's blocking your cash flow by diving into the numbers and analyze what you're doing currently as your cash flow management system. In 4 weekly group calls, we're going to dive into your cash flow and explore the causes and potential solutions together to get some quick wins while you build that long-term plan for your future. You'll also get Voxer access so that we can chat in between meetings. There's no need to have to wait an entire week to ask a question. You can ask me a question anytime in Voxer, and I'll get back to you during business hours so that you can move forward fast. My 30-day Cash Flow Catalyst group intensive starts on December 4th. I'm keeping the group small. There's only 10 spots available. If you're ready to tame the cash flow monster in your business so you can spend more time enjoying life, click the link in the show notes or go to my website, harringtonstrategicpartners.com, to secure your spot. If you're not sure if this intensive is for you, but you're interested in learning how we can work together to increase your cash flow, click the link in the show notes to schedule your cash flow strategy call. Thanks for listening to today's podcast. If you enjoyed what you heard today, please share with your network and leave a review so our podcast can have a greater impact. If you have any comments or additional topics you'd like discussed on the show, let me know. Before you go, connect with me on LinkedIn and let's keep the conversation going.